Welcome to episode 59 of the Cashflow Connections podcast. Our topic for today is how Joe Fairless analyzes markets, purchases apartments, and raises millions. Today, we're joined by a thought leader in the real estate investment space who has built up a significant and recognizable brand, which has allowed him to make some pretty serious moves in the industry over a relatively short amount of time. In fact, one of the ways that he's built up this brand over the years is by authoring several articles and 3 books. And I wanted to have him on the show today because his newest book is actually going on sale the day this episode goes live. So we're going to have a discussion about not only the technical aspects of real estate investing, but also how he has leveraged his brand to create a significant real estate portfolio for himself and for his investors. So in this episode, we're going to discuss Joe's 7-step market evaluation process. We're going to talk about the systems, the technologies, the processes that can help you invest, scale, and maintain your portfolio. This is really important when you start to get up to 500, 1,000, 1,500 units. And we're going to talk about how you can become a thought leader in a very competitive sector, such as the real estate investment world. We're going to discuss 4 metrics to check to ensure that you're actually aligned with your operator. I think incentive alignment is something a lot of operators talk about. There's 4 metrics that Joe really likes that you can actually look out to really verify this. And we're going to talk about Joe's mentorship program and how this has helped him raise millions for his own deals. Now, don't forget, it's only 2 months until the Intelligent Investors Real Estate Conference in Marina del Rey. We actually have a unique episode coming up. We're going to have some of the founders of FIBI come on. We're going to have a roundtable discussion so you can understand why I'm so excited that we're all working on this together. Other than that, Peter Fisher, who is the Cashflow Connections attorney, and he's also a partner at Sklar Kirsch, he just signed on to be a sponsor. Peter and I have worked on 10 or 12 full-blown private placement memorandums together, not only just the documentation, but also the structuring, everything that goes into creating one of those. He's a well-known securities attorney in Los Angeles, and he's a really important member of the CFC team. So I'm really happy that he's coming on board, and he's going to be able to share his experience and his expertise with the audience that is in attendance. Also, and I think this is a good bonus, about 90% of the time of the conference is allocated towards panels, which I think is great because you get to hear different people's opinions and perspectives, and this is really important, especially when it comes to things like legal and accounting strategies, because you get to hear a range of opinions so you can understand what works best for you and your situation and your personality and your financial outlook. So I'm sure you're going to learn a lot. It is really the way to get as much content in a 2-day period as possible. Regardless if you are a new investor or if you've been a full-time operator for a decade, the goal is to really make a really special and educational weekend for everyone. But, it's not free, right? And there's a ticket price to that, but that ticket price acts as a barrier to entry. And so the quality of the attendees is going to be really high. There's a lot of real estate investment meetings out there where 60% of the attendees, it's their first meeting, and they're mostly just there looking for someone to intern for, or they're looking for a mentor. I think that the networking component, because of the fact that it is not one of those $20 entry fees, is going to be really significant, meaning that everyone there knows that other people in the room are going to be able to help them and solve whatever problem they have. So anyway, it should be clear what the goal is of the weekend at this point. Basically, we're getting all the all-stars together, people that I've worked with for many years and have significant relationships with, allowing them to meet each other, meet some of the listeners of the podcast, share their knowledge so we can all really grow and network together, which is really the whole entire point. So don't forget to go to intelligentinvestors2018.com, pick up your ticket. Remember, they go up in price in about 7 days. September 19th goes up in price by $100. So make sure to shoot over there and grab your tickets immediately. All right, I hope you enjoyed the episode. How's it going, everyone? Our guest for today is Joe Fairless, who is a full-time real estate investor that started buying multifamily properties in 2013 and now controls over $400 million worth of real estate with a portfolio of more than 4,000 units. In fact, he has personally raised over $100 million from private investors for real estate investments. Prior to that, he was the youngest vice president at an award-winning advertising agency in New York City. And he is also the host of the world's longest-running daily real estate podcast, Best Real Estate Investing Advice Ever, where he has interviewed many guests such as Barbara Corcoran, Robert Kiyosaki, Emmitt Smith, and Tony Hawk. He's also been a guest on the Cashflow Connections podcast before, episode 26. You can check that out in the show notes page. Joe, it's an honor to have you on, my friend.
Oh, I'm looking forward to our conversation and grateful to be back.
Awesome. So obviously you've been on the program before, but for some of the newer listeners that may have not heard that episode yet, give us a brief summary of how you got started in the space and how you ended up in syndications particularly.
I got started because I was making $250 a month from 4 single-family homes on each of them. I was making $250 a month for each of the homes I had. I had 4 homes. But then someone would move out of those homes and I'd get a bill from the property management company for $5,000. And that number, the math doesn't work out.
Yep.
From a long-term standpoint, that's not very scalable. And certainly I could have scaled my single-family home portfolio and made it work. But because other people have, so I know I could have. But it just wasn't my area that I wanted to work on. There was just too much paperwork involved to buy a house, and it didn't work out for me, or I didn't see it scaling. So I decided to start learning multifamily, and simultaneously with me learning multifamily, I became apathetic towards my full-time job. And I was the youngest vice president of a New York City advertising agency. I started out as a junior project manager, making $30,000 in New York City, and living in a very dangerous area of Brooklyn when I graduated college. But I climbed the corporate ladder relatively quickly. And when I reached the point of vice president, I realized that it wasn't keeping me engaged. And so what I decided is I was going to leave the industry and focus on multifamily. And the ironic thing about that is I couldn't have purchased a single family after I left my job because I couldn't get approved for a mortgage. But I could buy a much larger property because then I could partner with investors. And some of my first investors were actually from, they're all people who I had a pre-existing relationship with, as is now. But I was teaching a class in New York City on how to buy these properties, these single-family homes that I was buying, because a lot of my friends were asking me about it. And one of my oldest brother's friends reached out to me and he said, I'd like to take your class, but I'm in Dallas. Can you just email me the PowerPoint? So I emailed it to him and he said, this looks good, but if you ever do something larger, let me know. And I heard that from a couple people. And what I realized is I had customers before I had an actual product. And that's the best business to be in. Mm-hmm. And so then I went from there.
Now, it's interesting. So you started syndicating those deals pretty early on, I guess, with your experience in single family, but then transitioning into multifamily. And I know that we are really close to getting this new book out. You want to tell the listeners kind of the name of the book and some of the highlights in terms of when that comes out and what's in there?
Yeah, the book's called The Best Ever Apartment Syndication Book. So there's no gray area about what it's about.
Very clear.
It's about syndicating apartments. And it's categorized into 4 sections. 1 is experience, 2 is money, 3 is deals, and 4 is execution. Because the main challenge I had starting out was I didn't have the experience. I thought I was going to be able to talk to brokers and say, hey, I'd like to buy this, $1 million property. At the time I was looking at 30 units. I'd like to buy this $1 million property, and don't worry because I've got this experience. I have 4 single family homes. And I thought they'd just be, falling at my feet trying to send me deals. And I was in for a rude awakening. I did not have the experience that was necessary on my own to get quality brokers to send me opportunities on a consistent basis. And so I focused one section of the book on experience so that you can be educated on what you need to know in order to do deals, how to put team members in place. And then 2, have those team members bring that experience and how to align yourself with those team members so that you truly do have alignment of interest for your investors. And I think it's important to mention that not everyone should be raising money, because there are certain things that you'll want to have in place before you do raise money, because it's a very important it's very important to be conscious of you bringing other people's capital that they've worked hard to earn into your deals. And so that's why I also talk in the book about what you should have in place prior to even thinking about raising capital, which is a track record in business where you've got a lot of professional accomplishments, or you've been promoted multiple times that show you're business savvy and you can catch on to things, and or a track record in real estate where you know the fundamentals and now you just need to hone your experience into and focus it on apartments. And then the next section is money. The third section is finding deals, underwriting deals, and then the fourth is actually executing on it.
Yeah, I really like that. And I especially can relate to you mentioning that you had, okay, look, one property, fine. One property doesn't make a trend line, right? You have to have two properties, but you've got four properties. So you're thinking, I've figured this whole thing out. I'm going to open the doors and the money's going to come flooding in. I can definitely relate to that. And I'm actually going to do an episode about my journey to my first $10 million fund, and how there was a transitional period where I had some wins professionally. And so I assumed that basically business was easy. It's easy to just go do business. But when you get into a bigger space and you're saying, we're talking about raising $50,000, $100,000 per investor, it's things change. Now, one of the things that you went into in your book is market dynamics and kind of analyzing different markets. Last time you were on the show, you're a big proponent of the Dallas-Fort Worth area. Are you still focusing most of your efforts on that market?
Yes.
And what are some of the steps, or some of the dynamics that you're still seeing that really match up with some of the market evaluation that you talk about in the upcoming book?
And I'll answer that question directly. Just to elaborate a little bit more on my yes answer, we just hired a director of acquisitions. He came from a private equity firm in New York, and he worked in his previous role with operators like us across the country. So he was exposed to a lot of different markets, and he's going to help us open up new markets in the U.S. So while we are focused on DFW, and we have over 4,000 units, and 90% of those are in Dallas-Fort Worth. So clearly, we're heavily focused there. We are looking at new markets and should have a new market open up in the next 6 to 12 months. But now to answer your question about DFW, all roads lead back to supply and demand, number one. Two is jobs, and three is diversification of employment basis. And from a supply and demand standpoint, Dallas and New York City have led the country in new construction for multifamily over the last 12 months. The other disadvantage of Dallas-Fort Worth, so I'll say the disadvantages first. One is there's a lot of new construction popping up. And then two is there's a whole lot of land in in Texas in general. I mean, I'm from Fort Worth, so I know this. Everyone in Texas, and most people who are listening know there's a whole lot of land in Texas. And that's not ideal for real estate. I mean, ideally you want to be on an island like Manhattan or San Francisco, where everything's really concentrated. So those are the disadvantages to Dallas-Fort Worth, but clearly we don't feel like those are critical issues to the market, because we have such large portfolio there. And the reason why is because there's so much demand for the apartment communities. I mean, just yesterday it was announced that a Fortune 500 company is leaving San Francisco and heading to north of Fort Worth, about 20 minutes from a property we're acquiring. We're going to be closing on. in next month. And we already have a property that's located in that area. And I believe that will make the 24th Fortune 500 company now that is headquartered in Dallas, Fort Worth. With that comes employees. And the important thing is the diversification of those companies. No one employer, no one industry makes up more than 25% of the employment base. And even if it does, then I believe you mentioned this on in an interview I did with you on my show. I can't remember though. But if it does, we've got to be really we've got to know that particular industry to make sure we're comfortable with the types of jobs that that industry has, and if we see that continuing or not continuing. For example, Flint, Michigan, where I was born, automotive kind of had hit some hard times over the last 4 decades there, and that's why my family moved to Houston, Texas, when I was 3 years old, because my dad he was a real estate agent, and no one was buying, and everyone was selling, but no one was really buying. So we ended up moving.
Right.
So those are some of the market fundamentals. At very, very high level, it's supply and demand, it's employment base, and it's population growth. And employment-based diversification and population growth go kind of hand in hand. But then you want to take a look at supply and demand. And the thing about supply and demand right now is it is expensive to build. And not only is it expensive to build, but it's hard to find good talent. It's really hard to find a lot of good workers to put together a project. It's the labor costs are high, raw materials are higher, and while new construction is taking place, once you reach the level or once you reach the point of completing a new construction multifamily project, you're going to have to command $50, $60 rent per square foot. And we're not competing against those types of properties. We don't have that type of rent per square foot. We might be at $1.25 at the high end. And so there's a different level that they have to charge that we don't charge for our property. So we're competing with different residents.
Yeah, I appreciate you going to that level of detail there, because I agree. It's interesting. It's an interesting time. It all comes back to supply and demand. And so when you're seeing a lot of construction, there is a tremendous constraint in the labor supply, which shoots up the price of construction, which means that it's only possible to develop, typically right now, for example, in markets like yours or in California, for example, Class A properties. And so workforce housing, somewhere in the range of, let's say, renting for $700 a month per door, or maybe $1,100 per month per door in a place like California, you really start to see that all of the, or a significant portion of that additional square footage is heading above that rental rates. So the square footage may not directly impact your business. You're going to see some decrease in occupancies on a metro-wide basis, but it may not come in direct contact with your actual product type.
Yeah, 100% agree.
That's kind of, yeah. Additionally, you talked about the diversity of employment, which obviously is critical. The one thing that, if you're looking at a large enough city to substantiate a full, robust economy, Detroit excluded, you're typically going to be in a good position. But when you do see an industry, particularly something like hospitality, which can be very cyclical, maintaining 25 or 30% of the overall economy, the overall workforce, you can have a serious challenge for years if you do suffer some kind of correction. When you think about conferences, for example, Las Vegas, they take massive hits when things like that happen. So just wanted to add those 2 points, because you just touched on something that I'm definitely really in tune with, and I agree with completely regarding both of those metrics.
Yep.
Now, let's talk a little bit about raising capital. This has been a big portion of your business. You managed to raise $100 million from private equity. That's no easy task, especially because it's private individual investors. How many investors would you see that $100 million really comes down to?
Largest investor has invested about 20 million of that. And then the others, on average, have probably invested, average investors probably 500,000 over all the projects that they're in. So whatever that math is the amount of investors. 80 million divided by 500,000.
Okay. Yeah, that's pretty tremendous, man. $20 million.
Yeah. Yep.
Yeah, that's pretty awesome. But even with that large investor, with still $500,000 net investments, and I know that you're taking on new investors all the time, what are some of the systems, the processes, the technological solutions that you use to manage that infrastructure of investors?
One is I use Contactually. Contactually is just you pay a monthly fee. I don't know how much it is, but probably like $50 or something a month. And maybe it'll probably less actually. And what that allows me to do is to have all of my investors on my phone, and it has something called buckets where you basically like group different things. So I have a bucket for all my properties. So I'm in the app right now and I click my all my properties bucket, and I can see each of the properties, and I can see who invested in each deal and how much they invested in that deal. I also have a bucket for the different levels of investors. So I have, if they've invested, say, 100,000, or if they've invested 20 million or something in between. And then I have the different potential investors that are in my deals. So for example, any investors who haven't invested but are I've had a conversation with, then they're going to be in there. And what that allows me to do is, one, prior to speaking to an investor, if I need to be reminded, or if I need to remind myself of what they've invested in, then I can quickly access that. But then two, it allows me to see who has invested what amount. And then we have different things that, different levels of engagement that we do with certain investors. For example, the investor who's invested $20 million from his family, we make sure, meaning my business partner and I, make sure that we have some sort of meetup with him and his wife on a quarterly basis, or at least once every 6 months or so. With the other thing that we have in place, it's called Accredited Investor Engagement Plan. And it's a spreadsheet that I created with my team. And it's basically, it has certain tabs on there, and each tab corresponds to the frequency of engagement. So it's a daily tab, a weekly tab, a monthly, a quarterly, and an annual tab. And I have something in place to add value to my investors' lives within each of those frequencies. So for example, daily, I have a daily podcast, a podcast that comes out, and I'd say, 60 to 70% of my investors listen to my podcast, or have at least listened to it once. And so that's a way to stay in touch with them daily. Weekly is a weekly newsletter. Monthly, it's something I'm proud of. It is a mailed out report that I call it the best ever report, because my brand's best ever brand. So it's the best ever report, and it gets mailed to investors monthly, snail mail. And on the cover of it, picture a program that you get at a play or something, or if you're at a football game, it's that type of material. And on the cover, it highlights an investor of mine. And then when you open it up, there's a story, a Q&A that I did with the investor, and it tells their story, how they got to where they're at, challenges they came across, what they've learned. And then on the back, it's a note from me and some comment I have about the interview. And that gets mailed out monthly. And my investors love that because, one, the investor who gets profiled, it's pretty cool to be profiled and have this. But then two, the ones who receive it, they get to learn about who's investing with us, number one. But number two, they get to learn tips or certain business strategies that someone who has had success in business is sharing via the interview. So I've done that now for 11 months. 11 issues have been put out. And we'll keep doing that every month. Quarterly, do a tour in certain cities. So Colleen, my wife, and I just this summer went to Los Angeles for a week, San Francisco for a week, Chicago, Philadelphia, New York City. And we have dinners. We have a happy hour with all of our investors in that city and potential investors. And it's just nice to get to know each other even more. And then annually, I've got a conference in Denver, best ever conference. And so as someone who's listening, if you're focused on bringing capital, the takeaway is to be intentional about adding value on a consistent basis, daily, weekly, monthly, quarterly, and annually, because when I think of it from, I think about the example from the book Ninja Selling by Larry Kendall. Very good book. It's focused on, ninja selling. So it's focused on sales, but he focuses the conversation as though you're a real estate agent. I am not a real estate agent, but the example he used resonated with me. He said, if you're a real estate agent and you blow the socks off your client and they love working with you and you find them the perfect house. I mean, you just nailed it, went above and beyond expectations. Good job. But if you don't stay in touch with them over the course of the next 5 years on a consistent basis, when they're looking to sell that house, they might not remember you. And they might receive a direct mail piece that moment in time from another agent, and that other agent might get their business. Not because you did anything wrong on the first transaction, but you didn't stay in touch and add value on a consistent and regular basis. And so that when I read that example in that book, it really resonated with me because we're delivering on our projects. But if I'm not consistently adding value on a daily, weekly, monthly, quarterly, and annually basis, then I'm not top of mind. And so that's the way that I'm very intentional about that.
Yeah, I'm actually really glad that I asked that question because that is all really useful information. And I appreciate you going through that level of detail, especially sharing that app that we're going to be taking a look at, because I couldn't agree more. It doesn't matter how much you deliver, particularly with something like a real estate investment, where let's say they're getting that quarterly distribution, and let's say it's just hitting the preferred return just as anticipated. That is not going above and beyond. That is not top of mind. And you have to be the number one first person that your investor thinks about when they hear of someone that has a couple of extra $100,000. They immediately need to go, wow, I just got this new email from Joe and he mentioned that they're in the process of raising money. And that's the way that you do that, by that constant contact and constantly adding value. The challenge, I think, is that some people get stuck in the paralysis analysis of what they should write. They don't want to contact their investors too much, et cetera. I can tell you from personal experience, there may be some people that unsubscribe to your newsletter, but the people that stay are going to be completely thankful for the amount of content that you put out. When I get thank you notes from people that I've taken an extra time to go into detail to answer some particular question, that is the type of thing that sticks with them for years to come. And in this space, it is not a money-making business to have one-off transactional investors that invest once for $50,000. It doesn't make sense. It's too hard to acquire new investors. So again, I really appreciate you going to that level of detail. I think there's a lot of important takeaways there. Now, one of the other ways, go ahead.
One other thing I'll mention is when you're thinking about staying top of mind and adding value to your investors on a regular basis, think about the different ways they're actually receiving that information. For example, when I was going through my examples, the first one was audio, subscribing to my podcast. The second one was visual, reading an email. The third one, they're reading the report that they received, but they're actually getting it. They're able to touch and feel it. It's arriving at their house. And, they might take it straight from the mailbox and straight to the shredder, or, straight to the trash can, but at least they're touching it, and it's in their house. Hopefully that doesn't happen too often. And hopefully it's, on their kitchen counter or whatever, and they share it with someone. And then the quarterly is in person and the annual is in person. So, in addition to being intentional about adding value, and it's not staying in touch, it's adding value on a consistent basis, be intentional about how that value is received so that you're hitting on all of the senses for that particular person, because we all internalize information differently, and it's important to make sure that you're addressing every area.
Yeah, great. In fact, I know a sponsor that issues monthly distributions, and they really, really fight doing ACH because they want to actually mail the check every single month. I think that's a little ridiculous from an administrative standpoint, but their whole thing is it's a marketing strategy, right? They just want the people to be like, wow, another one of these damn checks. And they're just piling up. And so maybe the investor goes to the bank every month or every couple of quarters or so. But still, that's totally valid. People talk about the fact that ACH is automatic. You don't really have to do anything. They're not remembering where they even got that money from. So it's definitely something to take seriously. I am a huge fan of ACH. So if you're a sponsor, don't do that to me.
I would actually argue that would have the opposite effect that the sponsor that you're talking about is intending. Because I have many investors who will mention that they don't want to deal with the hassle of collecting the checks, especially if they're a self-directed IRA investor, because they might be getting mailed the check and then they have to send it out to their custodian, which shouldn't happen. It should be sent directly to the custodian. But I think that would actually...
Well, people enter in the incorrect information all the time over the infinite scale. Yeah. It's all so much to deal with. And I agree completely. It's a kind of a hassle.
But conceptually, I get what they're looking to do.
Totally. And it sounds a little bit like an infomercial, but when I got started investing, I'm currently invested in 30 syndications. So if I were to have to deal with checks like that, I mean, it would not be like just a cute little nuance.
Oh, goodness gracious. Oh, man.
Now, moving away from the admin of just having to cash all the checks we're making, let's talk about some of your work as a thought leader. I know you address some of this in the book. You talk about some of the steps to being a thought leader and creating a thought leader platform. Let's talk about that and how you've been able to do that.
And we'll define what a thought leader is, and I'll quickly mention the importance of that, because that's really what drives all of this. And a thought leader is basically someone who you go to on a particular topic who knows what they're talking about. And the challenge that I had, and a lot of people have, who did not grow up doing what they're doing now, is they had to establish credibility with other people about that area. So, for example, I was a VP of an advertising agency. I invested in single family homes on the side, but I wanted to transition into commercial real estate. Well, there's a big old gap of experience and ultimately credibility that I needed to solve for. And the experience is solved for by aligning myself and yourself with the right team members. And credibility is solved for by having a thought leadership platform. And what a thought leadership platform is it's YouTube, a blog, a podcast, a Facebook group, even could be a meetup that you host locally. It's somewhere where you are responsible for gathering an audience and you are leading the conversation. You don't have to be the one talking. You could simply be the one interviewing the person talking. And that's how I was able to gain credibility relatively early in my investing career, because I created a podcast where I'm interviewing real estate experts. I was not a real estate expert, but I was interviewing experts. And that closed the gap on the credibility question. And that's a very important gap to close if we want to do commercial deals, because the perception is critical whenever you're speaking to brokers, whenever you're speaking to lenders, whenever you're speaking to property managers, and whenever you're speaking to your investors. The perception of you as an expert in the space is necessary. And this, having a thought leadership platform, allows that to take place. It needs to be an interview-based platform where you're interviewing experts, because what happens is you're learning the whole time, and they're going to share out that episode with their audience, and then your audience grows. Just like I'm going to share out this episode with my audience, and Hunter, your audience is going to grow as a result of it. That's just how it works. And my audience will then see you as being the expert that you are, and more people are going to listen to your show, and then you'll have more success in your business, similar to what's going to happen when this episode airs for mine. And that's the importance of having a thought leadership platform. I went over the top with mine. I've done a daily episode every single day for the last 1,500 plus days,
Right.
Every single day, Monday through 7 days a week. No one that I'm aware of in real estate has done that for that period of time. So it's not necessary to do over the top like that. But if you do, then you might get results in a faster period of time than what's typical. And so there are 3 keys to becoming a successful thought leader. One is consistency. I've done it every single day for the last 1,500 days. I've had an interview go live. And just for the record, I personally don't do an interview every day. I batch them. So I'll do 8 or 9 interviews on one day, and that will cover me for the next week and a half. And so I'm about at 30 days booked. So one is consistency. It could be weekly. It could be monthly, as long as you are consistent with it. And the more frequent, the higher the frequency, in my opinion, the more success you'll have and the faster you'll have it. That at least is what I've witnessed with my own ventures. So 1, be consistent. 2, tie in to a large built-in audience. And that's the key. With a blog, it's more challenging to have a platform that gets traction quickly, because you're just talking to your mom and your dog and maybe your significant other when you write a blog. No one else sees your website because your website was brand new. Compared to launching a podcast, you're tying into millions and millions and millions of other people who are listening to podcasts, and they can easily subscribe to your podcast. Same thing with YouTube. Same thing if you do a meetup. You're tying into a built-in audience. And it's just a lot easier to scale when you tie into a built-in audience versus a blog. And if you have an affinity towards blogging, my suggestion is to blog for a website like Bigger Pockets, or blog on Bigger Pockets. That way you're at least tying into a larger audience. It's not your blog, but you're tying into a larger audience. Then you can have in your email signature or your message signature a link to your blog, and then people can learn more about you there. And then the third, so 1 is consistency, 2 is tying to a large built-in audience, and 3 is being unique. Unique value proposition is what they call it in marketing. And basically, why do people listen to you, and what is the value proposition you give them or that you have, so that when they listen to you or when they read your stuff, they know what is unique about your content. And what's unique about my content is that there's no fluff in any of my interviews. I say that at the beginning of every show. We don't like the fluffy stuff. Kind of corny, but it's true. I don't go I don't sell anything on my show. My guests don't sell anything on the show. We just get the best real estate investing advice ever. And I talk about experience. They talk about their experiences, and I ask follow-up questions. So what is the unique value proposition? So those three things: consistency, tying to a large built-in audience, and the unique value proposition. Those are the three keys to becoming a successful thought leader.
Yeah, I really appreciate that. And I actually obviously agree tremendously. Particularly the podcast, it's a pretty remarkable situation because it gives you a platform not only to share information with your listener base, but also to have incredible conversations with people you respect. And real estate, one of the big draws to the asset class is the simplicity of the business, but the way that you can communicate the inner workings of the business can change significantly from person to person. So when you do these interviews, you learn new ways of communicating. It really helps you as a real estate entrepreneur, not only from thinking it through and understanding new strategies, but also communicating those strategies effectively, which is something that I've benefited greatly from interviewing probably 55 people at this point. I know you've interviewed hundreds. So yeah, I agree completely there.
Yeah.
Now let's talk about some of the avenues that haven't worked out as well. Have you tried something in terms of marketing that you felt was a waste of time, whether it was a particular platform or something? Yeah, I'd love to hear that.
Yeah, I bought a list. I bought a list from an email company that had a list of I don't know how many emails I got. I think like 10,000, maybe 20,000 emails. I've literally got no response from that, and I invested $2,400 bucks.
Mm-hmm.
And I tried to shortcut the process of building relationships with people. I tried to simply buy it, and I did some email campaign. I wasn't selling anything. I just, wanted to grow my podcast audience and my email list. I wasn't trying to, close them on a $9.99 product or whatever it was. It just fell completely flat. And, over, a couple $1,000s later, I realized that, that's just not the right approach. I also have, on my wall behind me, I'm turning my chair around to look at it. I have inspirational articles and mementos from my entrepreneurial ventures. So I've got, flyers from each of my properties that we own. I've got handwritten notes from Colleen, my wife, and from family members and from investors. I have the best ever report that I mentioned earlier printed out. So I've got 11 versions of that for each month. But I also have a picture of my friend who moved from Cincinnati to Atlanta, and it's a picture of his meetup that he hosted a month after moving to Atlanta. And the reason why I have this picture on my wall is because it's a packed house. I'm looking at it right now, probably over 75 people at that meetup. And he moved to Atlanta and hosted this meetup in 1 month. And when I moved to Cincinnati from New York City, my wife's from Cincy, so we live here. I started a meetup, and the first time I hosted it, it was 7-8 people, and it has since grown to 50, but I've done it every single month for like 2.5 years. And I was like, how the heck did he do that 1 month? And he got 75 people. I was happy for him, but I was also really jealous. So I asked him, I said, how'd you do that? He said, oh, well, I talked to someone who hosted a meetup, and he was looking to exit out. And so I said, well, can I take yours over? And he said, yes. And it made me realize that there are some shortcuts that work in our business, building an audience and, building relationships with investors. But there are also other shortcuts that don't work. So in this case, what worked was taking over an existing meetup and immediately having 50% more people attending than I had in mind, which took me 2.5 years to get to. And then the one that didn't work for me was buying a list, spending a couple $1,000s on that, and then literally got no responses, none, zero. and, figuring out that didn't work.
It's funny. I do appreciate that key takeaway, but I think that the real takeaway, the underlying takeaway is be open to those types of situations making an impact on your career. So I think that in the example that you gave, if your friend had sent you a photo of that, a lot of entrepreneurs might have said, "Oh, wow, good for him. That's crazy. Wonder how he did it." Moving on, as opposed to making it like a driving factor and completely, by the way, tying into one of your 3 strategies in terms of being a thought leader, which is making sure there's in-place demand already.
Yep.
And that's really remarkable. Like, obviously that ties in perfectly, but the real takeaway, in my opinion, is just being aware of what's going on around you. When you see successful things taking place, try to get as much as you can out of it, just as similarly as when you see something that doesn't work, trying to make sure that doesn't happen again. So focusing on that as well. So yeah, I really like that.
Very true.
One of the other strategies we've done is your mentorship program. You've taught a lot of people how to do what you do, how to analyze deals, how to raise capital, et cetera. Could you talk about how that process works? Talk us from, meeting the person, having that initial meeting to eventually get partnering with you on some of your syndications.
Yeah, it's a step-by-step program. I might update it in the future because I have too much demand for supply right now because it's not scalable how I've got it set up. But from a high level, I know you don't like high level. So specifically, you like getting the details. I like that. So specifically, it's a step-by-step process. And the reason why I do it, let's talk about that from a business standpoint. The reason why I do it is because my clients, there's about 65 people in the program. My clients in the program are all across the U.S. Everyone's in the U.S. Yeah, everyone's in the U.S. I thought I had one Canadian, but I don't. Everyone's in the U.S. and they live in different cities in the U.S. So I have visibility into each of the markets that they're focused on. Now, some don't invest in their backyard, like the ones who live in New York City don't buy in Manhattan. But a lot of them do invest in their backyard. So that allows Ashcroft Capital, my company I have with Frank, my business partner, that allows us a window into other markets where if my client has a deal that is too large for them, but they found it, then we can partner up with them. And so from a business standpoint, it allows Ashcroft to do more deals. Now, from the program standpoint, yeah, it's a step-by-step program where I help them from identifying what success looks like for our time together 12 months from now and learning the terminology, taking quizzes on terminology all the way through attracting private capital, underwriting deals, and executing on the deals. And that's one thing that gets glossed over in a lot of conversations is the actual execution part. And it's a shame because that's where the money can be lost the quickest is on the execution or lack thereof. And in my book that it came out yesterday, so it's on Amazon now, the book the best ever apartment syndication book, we have a whole section on execution and a chapter on asset management because like we're buying a property right now, about $50 million. We're closing on it in a month and a half. And investors ask, what is the greatest risk? And the greatest risk is, in my opinion, there are many risks, but in my opinion, the greatest risk is the risk of lack of execution. Because it's almost 400 units and we're renovating every one of the interiors and every one of the interiors is getting about $7,500 worth of renovations. You know this, but I'm just saying conceptually, think about 400 homes and renovating the inside of 400 homes.
Mm-hmm.
I mean, think of a fix and flipper doing a renovation of 400 homes. That is a ton of work, ton of stuff that can go wrong. Fortunately, it's 400 of the same homes pretty much. So there's the benefit of what you've learned from one likely applies to another. But there's major risk involved there with a deal. And so when we look at the type of execution and type of risk factors, that's one thing we look at. And that's why I put so much emphasis on not only in my program on asset management and execution, but then also in the book on execution and asset management.
Yeah, I really like that. It's like, we're going to buy a property that's got 400 units. We're going to rehab every single one of them, and then we're going to raise the rents. And the question is, what's the biggest risk? And you're like, oh, the part about the rehab, like the part about the 400 units. That's the important part. So yeah, that's pretty funny. One other thing I wanted to touch on, because I saw kind of a brief summary of the book, and it was really intriguing. And incentive alignment is something that gets a lot of talk. That's the first thing people say. It's really meaningful, et cetera. But a couple of key changes with the incentive alignment structure can completely change how aligned those incentives actually are. So I'm very curious into what those 4 levels are and how you really analyze that.
When you take a look at alignment of interests, there's going to be different ways that you can align with team members. And ultimately, when you want to build credibility with your investors and with everyone else, you've got to attract quality team members. And there's 4 ways to align yourself with quality team members. One of them, and I'll go from the weakest to the strongest. And even the weakest is stronger than not having alignment at all. But as it relates to alignment strength, I'll go from weakest to strongest. One is having a qualified team member simply on the team. And for example, a third-party property management company, they are a qualified team member. They have an alignment of interest because they get paid based on the amount of income. They get paid a percentage of the income that they are bringing into the property. So there is alignment of interest there, but not a whole lot, because if they bring in $100,000 worth of income on the property and their fee is, say, 3%, then that's $3,000. But if they bring in $90,000, their fee is $2,700 at the 3% fee. So it's a difference of $3,000.
Really important point.
Or excuse me, difference of $300, but it's a difference of $10,000 to you. So while there is some alignment, there's not a lot. Number 2, though, is you simply give a qualified team member an equity stake in your deal. And I interviewed Carlos Vaz. He's basically a competitor of mine, but I interview competitors all the time because I can learn a lot from them. And if they're doing good stuff, everyone needs to know about it. And he talks about on his first couple deals, how he just gave away most of the deal, but that's what he needed to do to get in the deal. So simply giving a property management company, say, 3% of the general partnership, just to say to your investors and to everyone else, yes, not only are they managing the property, but they are on the general partnership with us. That's number 2. Number 3 is having a qualified team member bring equity to the deal. So not only are they in the deal as a general partner, but they're bringing equity from their own bank account into the deal. That certainly shows alignment of interest because they believe in the deal so much they're investing in it. And the 4th thing is everything I just said, plus they're not only bringing their own money, but they're bringing their investor money into the deal. So now they have investors that they have to answer to if the deal doesn't go as planned, which would certainly lead me to believe that they believe in the deal a high degree. And these aren't just theory-based stuff. I have personally done all of these with our deals starting out. Now I sign on the loan with my business partner and that's it. We don't need someone else to be on the GP side with us. We don't need to partner with the property management company to give them the GP side. We're the ones on the GP. But when we started, my first deal, I gave away equity ownership I didn't give it away. I asked the brokers to invest their $317,500 into the deal, that they were receiving that as a broker fee for the deal. And so they did, and I was able to tell my investors, hey, we've got these brokers who have decades of experience. They believe in this deal so much, they're investing the $317,500 that they're earning back into the deal to be 25% owners with us. That's number 1 I've done.
Yep.
I've also brought a property management company. This is deal 2 and 3, brought a property management company on board. And when I say my business partner and I brought this property management company on board, and they had the balance sheet, so the bank account that we didn't have, and they had the track record that we didn't have. So what we did is they signed on the loan with us. They brought 30% of the equity for the deal, but they got 50% ownership in the deal. So we brought 70% of the equity, but we only received 50% ownership. So these are examples of ways that we can align ourselves with experienced team members, because it's so important that the people who have decades of experience have money on the line, whether it's their own money or whether it's their money to lose or whatever it is in these deals, because then you're really mitigating risk as much as you can. There's always going to be risk in deals, but as much as you can mitigate it by bringing on quality team members who have money to lose, the better.
I love it. And I am totally sold. I got your assistant email regarding the summary of the book. And I'm telling you, I've read a ton of real estate books. You know, at a certain point, you don't learn much reading most real estate books. But when I got the summary, I was like, I cannot wait for this book to drop. I cannot wait to give a copy. So before we jump off the call, Joe, I really appreciate you staying late as well. Let the listeners know the name of the book one more time and where they can get one.
Best Ever Apartment Syndication book. And you can go on Amazon, just search Best Ever Apartment Syndication book, and you can go grab it. And if you email the receipt to info@joefairless.com, we'll get you some goodies. I'm not sure what we'll have at that time, depending on when you buy it, but email your receipt to info@joefairless.com. Mention that you heard this on Hunter's podcast, and we'll get you something.
That's awesome. And I'll also congratulate you, because I think you're probably the third person in the history of the world that's written a book with the term syndication in the title. When I started this game in 2010, there was one book. I can't remember the title right now. It was very thick. It was basically just about the legal component.
Yep.
So the fact that you're doing this is a big move in the right direction. So Joe, I really appreciate you coming on. Thanks again, man.
Thanks a lot.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC, because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.